morning, good evening, good afternoon. Thank you for joining us. Welcome to the Mumbai FinTech Hub Global Market Access Series, sponsored by E&Y. My name is Anay Shah, and I have the distinct pleasure of being your moderator today for our session on navigating the African FinTech market. Well, I should start by saying there have been a lot of firsts during this COVID era for all of us, and being in Los Angeles, working with the FinTech Hub in Mumbai, and talking about Africa is yet another first. So thank you to our hosts for bringing us together. I'm joined today by our esteemed guests, Aaron Fu, the head of growth at Catalyst Fund of BFA Global, and Dr. Cedric, the co-founder of B Mobile. I'll ask them to introduce themselves in just a moment. But first, wanted to set the stage and share a little bit about where I'm coming from and what we hope to get out of this session. So as I mentioned, my name is Anay Shah. I'm the VP of Global Business at Tala. For those that haven't heard of us, Tala is a financial technology company on a mission to enable and accelerate financial health for all. The company was launched in Kenya about 6 years ago and has since expanded to the Philippines, Mexico, and India. We were among the first to launch a digital unsecured lending product based on an alternative credit score. Now that is much more commonplace, but 6 years ago it was quite revolutionary. And today, we have over 500 employees across multiple countries. We've done over $2.5 billion in origination to over 5 million customers who use Tala loans to start or expand their businesses, pay for school fees, pay bills, and build more stable financial lives with greater financial agency. Personally, I joined Tala about 2.5 years ago when I was living in Kenya. I lived there for about 2 years. My son also lived there for his first 2 trimesters of incubation. And I've also had the pleasure of working in 8 countries across the continent. My family's from Mumbai, so this panel has special relevance for me in multiple ways. So today we'll be taking a closer look at navigating FinTech in Africa. 54 countries, a multitude of languages, cultures, currencies, governments. And so in this conversation, it'll be in no way exhaustive to the full and dynamic FinTech landscape that is in Africa. However, we'll be taking a look at our collective experiences with our 2 panelists in leading companies and ventures across the continent and discussing some insights and predictions. I'm hoping for a free form and an engaging conversation with these 2 gentlemen on topics that include the advantages of the African tech ecosystem, factors to consider in expansion, experiences with regulation, the impact of COVID, and much more. And given the setup here we have today, that this is an AMA, so I will reserve time at the end for audience questions. So feel free to add them throughout the session into the chat function, and we'll be sure to get to as many of them as possible. And so with that, would love to turn it over to our panelists and have them introduce themselves. If you guys don't mind giving us a brief story of your background and what led you to dedicate part of your professional career to building FinTech in Africa. So let's start with Aaron, and then we'll move to Cedric.
Sure. Thanks, Anay. Really excited to join this conversation. So I spent most of my career in financial services. So I've spent more than a decade through a number of banks in Europe, Asia, and the Middle East. And I guess my last role in a bank was actually with Standard Chartered in Africa, looking at building digital financial services for them across 8 markets, and then saw so much more exciting things happening outside the bank than inside the bank. And so decided to kind of switch across to work with a Hong Kong-based venture firm called Nest to invest in African startups to take global. The thesis at that point of time was that, Africa is transitioning from a stage of importing technology to then building for itself to then being the source of technology for a lot of the rest of the world. We were particularly interested in sort of the similarities in demographics between Africa and Southeast Asia, Africa and South Asia, and sort of like, the global South, right? So I think it led the way with regards to mobile money. So we were very interested to continue to push that. I've since spent the last 7 years working in and around entrepreneurs in Africa. So whether that's pre-team, pre-idea with MEST in Ghana, or right now at the Catalyst Fund, where we specifically invest in fintech across Africa, India, as well as LATAM. We're really excited at all the lessons that can be learned between Africa and India, between India and LATAM, and sort of like, all across. And we don't think there are enough of those conversations happening. We're beginning to see a few African fintechs venture out of Africa. So whether that's to Mexico, or whether that's a little bit to India, we see a lot from India coming in, whether that's directly or whether that's sort of being inspired by Paytm models and other models that have been successful in India coming across to Africa. So yeah, very excited to be a part of this conversation.
Thank you, Aaron. Thanks for joining us. Cedric, over to you.
All right. Yeah, so my name is Cedric. I'm a tech entrepreneur, which means I never had a real job. And in my previous life, I built a cybersecurity company for banks. We used to secure banks. So I got to work with a lot of banks, and we got to see the plus and the minus, especially when it came to technology. Did this for about 10 years and eventually exited the business. And at that point, I lived in Hong Kong and used to go to mainland a lot and became really fan with like company like Alipay and Financial and even like Ping and really how they could leverage technology to a much bigger scale. And on the personal side, I grew up in Africa. Actually, I spent many years in multiple countries in Africa. So I always wanted to kind of do something there. And this was the right time. We had a bit more time, a bit more money. And we decided to essentially do a digital bank for low income in Africa. Like what's actually quite common now in Southeast Asia, but essentially it was kind of new or kind of slowly coming into Africa. Some pockets of the continent had it, not the whole place. And we had access to now, obviously as a technology company, things like blockchain and AI, which really allowed us to build value proposition and services that could enable that, this kind of underbanked market to be banked and do it in a way that was profitable. So started this about 2.5 years ago. We are now live in multiple countries. We started with essentially a remote KYC offer because it was important for us to be able to remotely open an account, like formal bank account, and with a payment proposition around FX, which is quite complicated to do in Africa because of exotic currencies. Not only in and out of Africa, but mainly intra-Africa. So essentially trying to displace in a lot of things that is cash and essentially cutting costs from, sending money from one country to another cost, 11, 12, 13%, doing it for like 2, 3% and doing it profitably. And eventually the B Mobile Africa company became a network of digital bank in multiple countries, covering, close to 30 currencies, 15 or 16 markets. And then we've added the offers from, the typical kind of payment, FX to also lending, and now we're looking at cross-selling insurance and other value-added services for that, that demographic. A large part of our user base is underbanked, like purely underbanked, unbanked, meaning they use very basic banking. And then a smaller part is more like what I would call kind of middle class, and those guys will use like debit card and FX and generate enough fee to pay for everything else. So we are a for-profit with purpose company.
Excellent. Thank you, Cedric. So clearly a rich histories to draw from during this panel. Why don't we set the stage at a high level for the opportunity we see here? So as everyone here probably knows, by 2050, close to half of global population growth is estimated to take place on the continent. And just by 2025, we anticipate seeing smartphone growth north of 600 million people. So fintech is a fast evolving industry globally and an even faster evolving one in Africa. But what's interesting about fintech in Africa is it isn't so much disrupting traditional financial services as much as it is building in a completely underdeveloped industry, right? And so these gentlemen and many of you in the audience are kind of on that forefront. And so I wanted to start just at a high level, and maybe we can start with you, Aaron. You know, fintech can mean many things to many different people. How would you characterize, you know, some of the exciting trends or industries that you're watching out for, and give us a little bit of the landscape that you think about on a daily basis?
Yeah, sure, and I'll be brief, but you know, I think over the last 4 or 5 years, you've really seen a lot of startups come lay a lot of the initial foundations of which the rest of fintech can be built. So you've seen the rise of Flutterwave, of Paga, of a lot of the Nigerian powerhouses when it comes to payments, really lay a lot of the rails, right? You've seen a lot of lending companies like yourselves and a lot of saving startups out there sort of like take a lot of the first steps, right? So we've already started gaining a lot of the learnings from that. Not all of them have been successful, but we do think the rails or sort of like cross-border payments as well as local payments, point of sale payments, P2P payments, like we're seeing a lot of that starting to form. And this wasn't the case sort of, you know, 7-8 years ago, whereby if you were a new lending company coming in, you would have to build a lot of those rails yourself, right? And so I think I'm really encouraged by that trend. So a lot of foundations are already there. The second thing that we see a lot of is fintech in context. And I think, you know, we've really seen a lot of strong propositions that are focused on fintech for, say, gig workers, right? Being able to give them a little bit of financial stability over a period of time, whether that's from an insurance perspective or a savings perspective, or fintech for millennials, right? Or fintech for farmers, where the use case of fintech is much more focused on a specific industry and sort of going much deeper there. So much so that, you know, the running joke that we have within the Catalyst Fund is that almost every company is a fintech in some way, shape, or form, right? At least in Africa, right, where you will touch some form of lending, where you will touch some form of payments, and that becomes a pretty core part of your value proposition beyond, say, logistics or beyond, say, education, right? We certainly see a lot of health tech startups, for example, have financing as a very large part of what they offer, the hospitals they work with, the practitioners that they work with. So we're really seeing the rise of embedded fintech as a theme, and we're really excited to continue backing companies that are developing very, very specific use cases for fintech, basis the rails that have already been built.
Yeah, that's helpful, and I think just acknowledging that 7 or 8 years ago, a lot of the opportunity we're seeing today was just so much harder because of that infrastructure and the success that stories that had not been there. Cedric, in launching your newest venture and scaling across multiple geographies, yeah, I'd love to touch on some of the main surprises you encountered in launching them, and how you've seen, this is actually a question from the audience, how you've seen banks respond to the rise of an offering like yours.
Yeah, surprises. We could write a book of surprises. Essentially, this is actually the challenges in Africa is you can't really plan. You have to be very adaptable and you have to be very reactive. The fun part is you have to be adaptable and you have to be reactive. So this is what makes the job interesting. But I mean, we had multiple surprises. I mean, like for example, so if you are unbanked, by and large, when you do something money related, you'll pay a lot more. That's just the reality. Whether it's sending money overseas, whether it's payment, everything is just more expensive. If you wanted to go get a loan and kind of unsecured lending, kind of on the side of the street, it's just more expensive than formal lending. So you would expect that a lot of those guys have a drive to really be formally banked. But then there's also apprehension with, oh, I'm not too comfortable with technology. What is this new company? Can we trust them, not trust them? And essentially changing behavior is very, very difficult. Or you have to be very creative on how you do it. It's not the typical kind of marketing the same way you'll do it in Europe or in North America. It's really, you have to be at the grassroots level, you have to be at the people level, and you really have to understand local culture, which means that it's obviously harder to scale because what works in one country may not work in the other country. I mean, we have like 50 plus countries, lots of different languages, cultures. So the scaling part becomes harder because it's not like, if let's say if you're a large country like India or China, Yes, you have regional differences, but overall, it's essentially one ecosystem that you can scale up. So lots of surprises around that, lots of surprises around how we deliver the service. Not the fact that it's lending or payment, but how it's packaged. In some countries, a mobile app is enough. In another country, you really need an agent to do it for them because they trust the agent network. In some countries, they've been exposed to mobile money, and so they're very comfortable with kind of mobile money 2.0. In some other places, they've just never seen it, right? And if it's not cash, then there's a trust barrier. So we've had a lot of surprises, but it's nothing really that blocks you. It's not what that is the issue, is how you go about it. But it's been interesting to really, especially go across market and seeing this kind of trying to find this commonality to be able to scale, because you can't be everything to everybody, but still maintaining the local kind of feel. So a domestic market will have a value proposition that really resonates with them.
Absolutely. And I think, we've all experienced and seen how, to your point, Cedric, it's very expensive to be poor, right? As you mentioned, everything costs more. It's harder. And that is the promise of the digital transformation that we're seeing. So,
and just maybe on that's exactly why we wanted to be a for-profit company, because we said, look, we can help people and still make a fair amount of money. And in fintech, of course, margins on the 80% plus. So to prove the model that, look, it's not because people don't have money that it's not a good business, and then you can kind of join the two. It doesn't have to be one or the other. And maybe just to touch on your previous comment on what have been the reaction of the bank, I will say pretty much inexistent. Our challenge is not bank, it's cash. I mean, the banks just don't. Number one, it's too costly for them. They don't want to deal with compliance. There's lots of politics, bureaucracy. So even if they wanted to do it, it takes time. But they usually have a country or a few countries to focus on. But that's an expensive segment of the population to service. So that's why you've seen the telcos being far more successful than the bank in many respects.
Yep, and Anay, I would just like to quickly touch on Cedric's point about trust, right? Because I kind of feel that a lot of why embedded fintech has been on the rise is really because beyond the learnings of agent networks and how communities trust the agents, they also trust the shopkeepers. They also trust the guy that sold them a motorcycle. They also trust the pharmacies, right? And I think these are ideal contact points to sort of come out with sort of like an individual or brand or an entity that people would trust, because otherwise financial services is sometimes quite scary for a lot of people, right? Anecdotally, like we hear through a lot of surveys that a lot of people feel that walking to a bank branch is not for them, right? That they don't relate, that it feels like a place for someone in a suit and tie, that it's just not like they trust them, but they're just not sure about the relationship. So being able to deliver financial services where they are comfortable and where they relate to and where it's appropriate to them, I think is really important to build that trust.
I think it's a critical point. And truth be told, they weren't allowed to walk into bank branches historically, right? So there's a lot of legacy there. Cedric, both of you touched on this point of regional differences, which I want to dive into, because I think it is so important when we talk about Africa, right? A continent of just massive scope and impossible to kind of characterize in any one sweeping statement. So let's get into kind of regional differences and a little bit into kind of going to market. In our experience at Tala, we've found it quite helpful to have a framework and a playbook in place to evaluate opportunities as we look from market to market. And we, as a company, we do aspire to serve multiple different markets and billions of people along our journey. And so before entering any market, we'll look at a combination of factors. We've got 27 point scorecard that we go through with our expansion SWAT team, and the common ones include Android smartphone penetration for us, the existence of the infrastructure and rails that you mentioned, Aaron, the need and desire for the financial services amongst the middle class, how regulation plays into that, the political climate, et cetera, et cetera. But once we kind of look across and employ our playbook, as Cedric was mentioning, everything ends up having to be customized at some degree, whether it's product market fit, it's user needs, it's the infrastructure, it's our regulatory setup, it's it's as simple as language and as complex as the product infrastructure. And so regional differences play a big role, particularly in building a for-profit company, right? It's expensive to do this unless the business case can support it. And so, you know, what some have seen and gets written about a lot is the kind of triangle of Kenya, Nigeria, South Africa, right? That's where a lot of the businesses have flooded. That's where you see VCs based. Curious to hear from you. Do you see those three markets as kind of the core places where you would start to build a business if you were entering? And then how do you think about building business models that thrive across those differences and then outside of those markets?
All right, maybe we start on that. So those three markets are the market, and we started in none of them. So the analogy I can give, maybe if you're in Asia, is if someone is from North America or Europe and they're going to do business in Asia, you could do India, and India is a giant market on its own. You could do China, and just China is already a big, or you could do Southeast Asia, and that's, you know, and so it's more how you want to play it. In our view, because we have a payment and cross-border kind of exotic currency thing, we didn't want to start in Kenya because Kenya is already quite mature. I mean, M-Pesa has been around. I mean, there's a lot of payment proposition. And we didn't want to start in Nigeria because Nigeria is really the market where you're going to make a lot of money. So we rather start somewhere else, iron the details, and then when you scale, you go to Nigeria. And in South Africa, it was our second market. So we piloted somewhere else and then went to South Africa, primarily because, of course, big economy, a lot of cross-border trade, lots of people from Zimbabwe, from Congo, so a lot of flow of money, which really plays to our strength. But I will say those three, if you have a Africa strategy, at some point you're going to hit those markets. And I will say I will probably put like Ethiopia and Egypt as well, just because very large market, lots of needs. At some point you're going to have to do one of those. But yeah, we decided not to start there, to be ready to do it well, because that's the market that you can't get wrong. And those are the markets, especially Nigeria, where we're now getting, you have to be extremely fast. You have to have the right skill, and it goes really, really quick. So you essentially have one shot at succeeding in that market.
Yeah, no, I couldn't agree more. I think those three markets are actually the only three markets that Catalyst Fund currently invests in fintech in Africa, and so certainly those are definitely the leading ones. I think, you know, between the one common characteristic between those three markets is that you can build a very, very large business by only being in each one of those markets, right? Like if you owned, you know, agriculture, mobile finance in Nigeria, it was a tremendous business already. You don't need to go anywhere else, right? And so I think there's a high concentration of businesses that see that opportunity and want to look at it there. I also think there's a high concentration of talent in those three markets. So I think being able to access that, I think, is really important. And also capital, right? At the end of the day, these are also the three most mentioned markets globally. And therefore, you see a lot of global capital focusing their attention on businesses that are there. Yes, absolutely. You know, I do feel that if you wanted to be in multiple markets, then maybe starting in a Rwanda, or maybe starting in a Ghana, or maybe starting somewhere else where you naturally get pushed out, because in order to grow, you do need these other markets. I think that's great. And it also kind of makes you immediately Pan-African from day one. It makes you think a lot more broader. It makes you less bottled in terms of thinking about just Kenya or just Nigeria, which again, I think back to Cedric's point, it depends on your ambition and it depends on the kind of company that you want to build. You know, for example, I think if you were to build a company in Ethiopia, a big question to me would be like, how much of the technology you build and how much of your processes can actually be applied to, say, Cote d'Ivoire or Senegal, anywhere else, right? That to me is a really, really big question, whereby you see sort of like Nigerian companies being able to raise a lot of capital, get a lot of talent, and then use that as a strong base to then address other markets, right? And even if, you know, Senegal fails for a Nigerian large fintech, that's okay, because they still got a large market to fall back on, whereby if your home market is much smaller, it's much tougher. But I actually, just keeping in line with the theme of this conversation, I think that, you know, a lot of Indian entrepreneurs would be very geared towards thinking like this, right? I think a lot of people see India as one country, but in reality, you know, regulations and cultures and adoption rates between Maharashtra and Kerala are just like completely different, right? You almost have needed to build like, you know, different kinds of products and different ways of reaching your customer even within then. So I think the cross learnings there are pretty significant. I think one thing to mention before I cede my time is also you also see a lot of blocks. So for example, within the ECOWAS area, you see like within the CAF area, so the Francophone that currency area zone actually has pretty aligned regulations. And so there are some advantages in positioning yourself in markets where there is a regional block where regulations and maybe some form of cultures are shared. So that's, I guess, another element to consider as you consider where to start your base.
I think it's a very good point. Looking at Africa in blocks, and I think in our case we use 5 blocks is a good way to do it. Because yeah, you could just do Nigeria, but then yeah, if you do something in Cote d'Ivoire, it's probably going to be applicable to Senegal, and the cost of going from one to the other is actually very nominal because same currency, same similar regulatory, culture similar, same language, but the cost of going from Nigeria to Kenya will be very very different. But then from Kenya to Tanzania, it's not too bad. So you have to look at blocks, but I think the a big advantage for people operating in India and coming into Africa is that they are themselves coming from an emerging market. And thinking emerging market in terms of execution is far more successful in Africa than thinking kind of Western kind of educated type. You have to be very tactical, very pragmatic. And a lot of those kind of, I mean, we see with Chinese companies who are able to execute on some of the things that are very complex in Africa, just because that's just the way they think. And it will be very hard or much harder for like someone who's like from France or Belgium, just because they may have commonality in the past with some of those countries, the execution on the market and the way you build a business is very different.
Absolutely. A number of interesting themes coming out here, but one I'd like to just make sure we reinforce in terms of what I'm hearing is, if you're thinking about bringing an existing business or launching a new business on the continent, the markets, primarily Nigeria, Kenya, South Africa, as Aaron was mentioning, can sustain a for-profit enterprise with its economy unto itself, right? It's, as he mentioned, it's got the TAM, the addressable market, it's got the talent, it's got the capital, it's got that infrastructure. Versus if you're looking outside of those three markets, then perhaps by definition you're looking at a more regional or Pan-African model, in which case the way you're going to build and launch your product will from day one think about multi-country. And so I think it's an interesting way. And then to Cedric's points on the blocks and understanding how some of the regional differences and some of the regional similarities can actually play to your competitive advantage. So no, thanks for that. I'm going to do something, put you guys on the spot a little bit. Hope that's okay. And so we've got Cedric as an entrepreneur launching this bank to the underbanked across multiple markets. We've got Aaron who controls the capital. So Cedric, would you mind giving us maybe your 1 to 3 year vision elevator pitch for banking the underbanked? And Aaron, would love to hear, as an investor, what strikes you about this opportunity and what are the challenges that the Catalyst Fund would find in this opportunity?
I'm actually very keen to hear Aaron's view because we built it in a very different kind of non-VC way. So it'll be interesting to see how, from the VC standpoint, how you look at it. Because essentially, I mean, this is personally founded, and our objective essentially, we want the bank to be around in 20 years. So we did a lot of things which are, I would say, a long-term benefit, but short-term disadvantage from a capital raising standpoint, and that's why we had to kind of finance it ourselves. For example, because we want to essentially be the kind of the lower income segment with a middle income paying for everything else, we had to build a lot of infrastructure, meaning if I'm in a country where maybe people don't have a date of birth or another form of ID, my system of banking has to use it's going to be a closed system. It's going to be a closed loop system. So they can do the cash in, they can do the cash out, but then they can't do international transfer. But then for the people that we can do a full KYC on, it really acts as an offshore bank account in multi-currency. So we had to go get banking license, electronic money license, payment infrastructure to build it on the blockchain because exotic currency was very hard to do on Swift and other platforms before we even opened shops. So essentially, the lots of infrastructure, no users, then you launch, and then you hope the user come, and then you hope you can attract a significant number of paying users to essentially cover the cost for everybody else. So a bit of a risky model. Now we have multiple licenses, we're playing multiple countries, multiple currencies, and we essentially had to divert also and bring in additional retail corporate account because the volume is much larger and the fee are much larger. So that's kind of where we are now.
No, cool, great. I mean, I think at the Catalyst Fund, we definitely have no problem backing founders that have bootstrapped and sort of like, you know, been their own initial seed funder. I think it's always great to see sort of like skin in the game on that. I think generally, like, we do prefer to see, you know, some form of like other external investment in there, whether that's like an angel syndicate or like even a micro VC. I think like that really helps. I think I would be very curious about, you know, how you've been able to adapt the product basis all your learnings, because like, you know, I large infrastructure costs upfront, I recognize that might be necessary, but you know, I would be more curious about what the steps you took to inform how you built that large piece of infrastructure. And we've seen a lot of models where, you know, the middle income tier pays for the lower income tiers to actually access the service. I think that's really tricky because, you know, it's almost building like two separate products, right? With the hope that the cross subsidy actually works. And I think sometimes we've definitely seen that sort of, and we've seen a few of our companies which initially started with that model become more and more attracted to serve the middle income groups because they are more profitable, because they are a lot more easily addressed digitally, they are a lot more savvy digitally, and tend to move away from the lower income group. So at Catalyst Fund, we care a lot about investing in fintech that is serving the underserved, and those very often are lower income groups. And so I guess if you know, we were to have a further chat, not, that it would really be about like, what is that commitment to continue serving the lower income, right? Because it is very tempting to move away. And how core is that lower income to what you want to build? Those would be some of my initial reactions. I mean, obviously, I would love a visual representation and stuff, but I guess basis what you're able to share in such a short period of time, hopefully there's a good enough reaction, Anay. I don't know.
Yeah, no, appreciate that. Cedric, any
Good enough.
any follow-up?
No, I mean, for us, you have to. I think it's not, and I've had that conversation with multiple VC. It's not right or wrong. I think you have to also understand a VC has a fund and there's economics in the fund, and it has to do certain things. And people don't realize that. They say, "Oh, I don't want to get signed a check." No. It's just it has to fit the fund mandate as well, and where in the life of the fund is. In our case, we didn't want to build, let's say, so a typical VC fund, in my view, would have been build a small niche product, acquire a bunch of users, then branch out. And economically, it doesn't work for the underserved for the exact reason that Aaron mentioned. So because we had the luxury to be able to finance it ourselves, we essentially say, okay, we'll do the hard work, build the infrastructure, get the banking license, which essentially took 2 years of work, which is a long time, a lot of capital, to then be able to say, now we're a bank, now we can do all the stuff, and the economics will work. So of course it generates money day one, it's profitable a lot faster, but it's a much more risky game, and you need to have the finances to be able to do that to eventually succeed. Because if you die in between, then you lost it all. So it's just a different approach to building the business, but that's just because of the long term of what we want this to become. Versus, it is not in our interest to raise hundreds of millions of dollars. If we do great, but if the business is profitable within a year, we'll be very happy, and then we have other options to kind of grow it. And that's where we've been also keen in our business to build more services, from payment to lending to term deposit to insurance to other stuff. So we have multiple revenue sources, and then it can really add to the P&L and cover this kind of subsidized piece. But Aaron is absolutely right. It's very tricky to build one product that serves the two, because the needs are actually significantly different, and the execution, how you roll it, how you package, is also very different. So you end up having essentially, two divisions within the same business, and it's hard to keep them together and not split them up into a non-for-profit and a for-profit business.
Absolutely. I mean, I think this idea of segmenting and really understanding who your customer base is and how you're going to build a business model around them, and not necessarily trying to straddle and take on too much, could be a pivotal decision for an early startup entering the market. Well, thanks for that little pitch exchange and indulging us. So something that has been coming up through the Q&A and that we've mentioned a lot is the regulatory elephant in the virtual room, whether it's minimum shareholder funds to apply for fintech licenses in Nigeria, or populist regulation that will restrict access to credit in other markets. The regulatory environment within any one of these countries is dynamic, let alone across multiple countries. And so, with us speaking to startups and companies looking to enter, I'm curious, maybe we can start with Cedric and go to Aaron. What advice do you have for companies entering the continent in a regulated industry such as financial services?
Okay, so I will caution people to think long and hard, 5 times over, if they really want to be in a regulated business. I think it comes with some advantages, but it's a lot of work and it's very complex. Because the continent is so big, there's such a large diversity, from very sophisticated, good infrastructure, to gray area, to it's good today but it changes tomorrow, to you have official rules but in practice it's more who you know than what you do. And so you really, and then of course it's regulation, so it's important. So you really have to pick either the right market or the right approach on how you get the license. And if someone, we say in Africa it takes 3 days or 3 years. This is essentially it's going to be very quick or it's going to be very painful. And that's why I think it's a very big deterrent to a lot of people, whether it's payment or lending, or there's just so many variation and things between what you think it is and what it actually is when you do the process, that it's very, very complicated. So I will say, if one can, of course, tagging along someone's license or starting in a different way is fine. But if you're going to have to get your license, start early and have a fair amount of budget, and you're going to do some FaceTime. You're going to have to be there in person, and you're going to have to be there often, because the FaceTime is very important. And if you do something like, for example, we use a pretty sizable blockchain infrastructure for payment to move money and do FX using stablecoin in a cheaper way. If you say blockchain, you're already not entering the room, right? Because blockchain is Bitcoin. No, it's not the same. So there's a lot of education to do, and not everybody wants to be listening. So sometimes you just can't change someone who doesn't want to be changed. So finding the regulators that is at least open to hearing the conversation and hearing the argument is one thing. And then you have to keep in mind that the regulator's job is not to help you, it's to protect consumer. So, their job is not to rock the boat. Their job is to be on the caution side. So even getting a license with restriction takes a lot of time, because that's work, and they have to protect the downside. So it's a really painful process. But once you have it, of course, that's a good kind of defense argument against the next competitor.
Yeah, couldn't agree more with all of Cedric just laid out. I do, however, think that similar to how a lot of fintech has come in the last 5-6 years to lay the rails, I think a lot of that initial education has already been done. So I think, again, what's different between now and sort of 7 years ago is that now if you walk and speak into some of the Nigerian regulators or some of the Kenyan regulators, like they are a little bit more familiar with blockchain and a lot of other new technologies that are coming through, and they've built very specific task forces and teams to look a little bit more deeply into it. As to how open they are to change, as to how open they are to adapt the regulations, I think that's still a further step to take, but I do think that a lot of the initial education has already been done, and I think you're right. It's about over investing in making sure that the regulators feel extremely comfortable with what you're doing, over engineer the safeguards, over engineer the protection, and really get as much industry buy-in as possible, right? I mean, obviously, you've also got political forces at work beyond consumer protection. And so making sure that all the stakeholders are properly addressed, I think that's also sort of really key. But, I think at the end of the day, it's not doom and gloom. That there are regulators which will progress conversations. We've also seen the rise, I'm sure, Anay, you're familiar with this, but we've seen the rise of a lot of self-regulating bodies. So whether that's the Digital Lenders Association in Kenya and a few others that you see in other jurisdictions. And I think that's a really progressive space for people to be in. because that way, you're kind of showing the initiative, you're kind of doing the work on their behalf, you're writing the policies, you are gathering feedback, you're monitoring yourself, and I think like that's sort of, I guess, taking control where possible. So yeah, I don't necessarily think that, going into a regulated industry is, never do that, but go in with trepidation and go in with a large enough war chest as well, right? I see a lot of fintechs trip up around needing more capital to finance a license or to, satisfy other new regulations that pop up 6 months later that you require X liquidity pool in order to continue operating. And this will happen, right? And I think you've just got to build your business plans to cater to that and make sure that, that's all budgeted for and that whoever has invested in you is willing to bankroll you to invest in those things.
I think that is a very good point. Having a lot of extra cash, very much needed, because capital regulation for banking goes up all the time, never goes down. You have countries that will impose a tax on digital communication, digital payment overnight, and then your profit is gone 30%. And people also look at the license and say, oh, capital requirements $1 million. No, this is just to be in the game. You're going to need probably 5, because if you just bring the minimum requirements, you're not going to get the license. It's just not going to happen, right? So you really have to understand the thing at play. Back to what you said, Aaron, I think Kenya and Nigeria specifically are very, very progressive regulators. And I think they understand the need of being progressive, but also they have to be forced because their own market was bubbling so much that they had to get on it. But it's obviously outside of those two, I mean, South Africa to some extent, but it's not the case everywhere. And then the last point I will add is when you pick your market, if you're in payment, for example, some countries have capital control. So you really need to read the rules, because if you're going to be doing like cross-border stuff and then you have capital control, it's very different than, if you don't have capital control.
Absolutely. I mean, a clear theme here, which I think will be no surprise to any company operating in India, where regulation is on everyone's mind, is thinking hard and making sure you're prepared to do the education if you need, build the relationships, over engineer and over invest, as Aaron was saying. This point of looking for and perhaps joining self-regulating bodies could be a way to enter the industry. And one thing, while we are competitors in these markets, we do have to work together with our competitors, because at the end of the day, at least the way Tala looks at it, is we're all trying to advance the same agenda and the same cause. We're trying to provide financial services to those that don't have it, and it's not a winner take all market, right? It is too big of a market to think that way. And so, in our sense, we're kind of happy to sit side by side with those that we may be competing against, because at the end of the day, we're hoping that the tide rises and raises all boats. And then this point on having enough capital and the capital regulation that Cedric mentioned, as the folks on the call are thinking about their plans, that is a critical and potentially make or break scenario planning that you have to do. And it could involve, rather than necessarily committing up front, it's have a longer game plan, right? What we do is kind of look at a market, build some relationships, understand the market over a period of time, and then prepare ourselves to launch. And in that time, kind of having built some of those relationships. I'm curious, Aaron, as you look across fintech and your portfolio and see the hundreds of pitch decks you get a week, I'm sure. Within the thought of regulation, are there business models that you find particularly more attractive and ones you find less attractive to help someone think about how, if the types of businesses they have to enter these markets?
Wow, I think within the context of regulation, I think one thing that's the simplest thing to mention is that if your business requires a license that costs $5 million before you've made your first $100, I think I would reconsider that approach and that proposal. But I think it's important to us that the founder has thought about how regulations will play out, that the scenario analysis has been looked at, and how they will intend to respond in all those scenarios, right? Like, I think it's less about whether or not we believe that that regulation could be a hindrance 1 or 2 years later. I think it's really about how we believe the founder will respond to changing regulation, and if they've thought it through. So I think that's a really key part of any pitch where you are dealing in a highly regulated area. I think the other approach is also to do with partnerships, right? Like very often, partnering with a larger financial institution or a larger body might actually help you get over a lot of those hurdles, and also maybe help you get through your first 6 to 10 months to get all the experiments you need in to build the initial product, to get the initial users. And then if you need to figure out, you need to raise a lot more money to invest in the license, sure. But certainly, I think I've seen too many pitches stumble by not considering the various regulatory scenarios, as well as upfronting the spend on regulatory without having a product in market.
Yeah, absolutely. Last question on regulation. It just came through the Q&A. This is clearly on everyone's mind. But
we should rename the session totally just like regulation only.
We given kind of the positions of both of you, have you found any difficulties for foreign companies navigating or acquiring the licenses and regulatory hurdles they need to overcome? So we're thinking about these Indian companies that are coming over. So is there a particular challenge you've seen as a foreign entity obtaining a particular license?
So it's a sensitive question. I will say yes. I think in some markets you will be, even though the countries are open to foreign investment and all that stuff, you will be treated with suspicion, because people may assume, since you're a foreigner, you don't know the market, you don't know, so they think you're just coming to do like what's the catch? Especially if you come with a, which is our case, a low income proposition. Why would you do that? Why are you trying to help us? So there's sometimes in the regulatory side, in the market not so much, because people are very happy to at least have options. But in regulation, we've seen it play, and it's also we don't operate in Kenya. I'm pretty sure that's not the case in Kenya, because they've been through the cycle many times, so it's common now. But if you go to a country that is fairly new, that is kind of on the rise, and they haven't had that much exposure, or they haven't seen that many deals, that many pitch, or that many business model, I think they will be. Nobody's going to block you, but it may take a bit of time to establish credibility, or the fact that what you do is what it says on the tin. And that's why I think in Africa, FaceTime you just can't do it without FaceTime. You have to spend physical time being on the ground, and there's just no other way to do this. And also, the longer you are committed in the market, it's the better place to your advantage, right? Sometimes, obviously, those regulatory things takes a long time. And then when you say, well, we're going to do X, Y, Z, and then 6 months after you did it, okay, then 6 months after you also did, then people start taking you seriously, because they're like, okay, those guys deliver. Clearly, they've been consistent. And then you have this kind of acceleration. It took a long time, and then suddenly things go a lot faster. Or you have COVID, and then they really need digital, so now it goes faster.
Yeah, makes sense. I kind of feel that there are various ways to prove how local you are, and I think a large part of it is also about making sure that you go in with the right advisors and partners on the ground, right? So you could be foreign, but if you kind of say that, but the guy that is running my local operations used to lead X bank or X institution on the ground, I think that certainly helps in terms of the team and the investors and the board that you have running the local entity. I think that has been some way of indicating local rootedness. I think obviously also, as I mentioned earlier, if you come in with a bank as a partner or another institution as a partner, it helps de-risk that a little bit, I think, in the regulator's eyes. So again, showing local rootedness and local awareness. And I think it's not all, I think there's some advantages from coming in from a foreign place and seeking local licenses, is that sometimes local regulators can take foreign regulators control over you, or sort of their due diligence on you as a proxy for themselves, right? And it kind of depends on where you're coming from. So for example, I'm from Singapore, and our monetary authority, our central bank, works a lot with the Kenyan government and their authorities to figure out how we can align regulation. So trying to create sort of that pathway for, if you are domiciled in Singapore and you're regulated in Singapore, then Kenyan regulations can take you as par. And so I think it also is a matter of figuring out what you can leverage from the support network available in India, or elsewhere to help you speak to the regulators, address those regulators, and maybe try and get some get further support. So I don't necessarily think it's just a disadvantage. I think there are some advantages from being based and regulated outside of the continent as well.
I think on that
That's a
piece,
great
yeah,
point.
Singapore is a very good jurisdiction if you're in Africa. I mean, it gets a lot of credit, and of course, they've done a lot of good things. So it's widely recognized, I would say. The EU and the US as well, of course, just because international standard, so people know what it means. But you can also see other, I guess, more progressive jurisdiction, especially when it comes to crypto or blockchain. They're like Japan, where people look at, oh, how did the Chinese or the Japanese did it, and then eventually try to make their own version. But yeah, I think there's definitely, from a regulatory standpoint, a lot more communication between regulators than what most people think.
Absolutely. One of you did mention the magic word, which is COVID, and so with 9 minutes left, I'd be remiss not to talk about the historic pandemic that we are all living through and navigating and managing our businesses through. I, for one, have some battle scars myself from the past 5 months, but curious from both of you, what's one or a couple key learnings or maybe a story that you're going to take with you from Q2, Q3 of this year into the future? So fast forward into a couple of years from now, how are you going to look back, and what's a key learning from this phase of the year and how you've had to navigate, or your businesses have had to navigate the pandemic? We can start with Cedric.
Yeah, it's unusual times. So I think for us, luckily, it actually has been a plus because it essentially forced a lot. Keeping in mind we're in the money moving business, well, you can't physically go to your local store to move money anymore. You need a digital option. You don't want to touch a debit card. You want to do a mobile payment. So there's been a lot of kind of thing that have accelerated. But I think the biggest change has been culturally. People were on the fence, really realized, oh wow, we do need digital solution, and we're gonna have to do this because it's not like, I think before it was like, yeah, maybe we'll do it. Now it's like, okay, we got to do it, and we're probably going to do it sooner than later. So that big change brought a lot of corporate for us and brought a lot of new market where people were saying, okay, we have only traditional method. Please, can you come in and bring something digital to this market because we need more options. So I think that's the plus side. The minus side is obviously when you get such a spike in activity, well, you can't just double your workforce and your headcount overnight. If you need to raise money because you're growing, sure, it's better to raise money when you have a bunch of traction, but nobody's going to send a check in 2 weeks. It's going to take months. So there's some logistical implication of many maybe not having the resources to service, or to not have, you have to take the clients, but it takes longer to onboard them just because of so much. But I think for us, it's been a positive overall, and it definitely helped with some of the narrative on the benefit of being digital and the benefit of having like more fully digital operations as opposed to like brick and mortar or a combination of.
Yeah, I think I would go one step further and kind of say that one of the benefits of the pandemic, as if there are any, really was this big push towards digital, right? And we've sort of seen not only businesses wake up to the fact that if they were more digitally enabled, they would have bounced back quicker, or they would have been more stronger, and a whole bunch of those things. But you also see a lot more resources being dedicated to that, right? Whether that's governments or foreign DFIs or foundations, I think there's a lot more resources now than ever to digitize small businesses and to digitize operations and livelihoods, right? And so I think there's a lot of good news there. I think to Cedric's point around sort of cross-border, one of our portfolio companies, Chipper Cash, they weren't intending to raise so quickly, but certainly because of the pandemic, they were quickly able to raise the last one was like 13.8 million. And that was closed over 2 months less. It was very, very quick. And so I think there are a lot of businesses that are accelerating. I think since the theme of this has also been regulation, I think I also see a lot of regulations loosening up, maybe not directly related to fintech, but for example, in the space of telemedicine, right? Like it used to be illegal for a doctor to prescribe purely digitally in South Africa, but with COVID coming through, suddenly digital consultations are the norm, and so that has freed up a little bit. The parallel to that is, again, in Kenya, you've seen the transaction fees drop tremendously. What previous things that would have been prohibitive with that level of transaction fee would now be worthwhile and actually sustainable. I think that's really interesting. So I think there's lots of opportunity in all the craziness of it. Obviously, there will be many businesses that will not survive at the end of it, and I guess that's kind of reality. But I think there are a lot of opportunities where businesses can sort of like pivot to and sort of like reinvent themselves and take advantage of it too. So definitely not all doom and gloom.
Definitely. I agree, and I'm looking to the Q&A, so keep sending them in. On that point, in case we have any experts here between the two of you, there's one question on acceptance of eKYC for banking or lending, and how that is prevalent across markets, or how that's changing. Any thoughts particularly on eKYC?
So of course we are in the middle of it. I think it varies greatly. Some countries are very familiar with it, and then some countries have robust ID system where everybody is an ID. ID is very high quality system, interoperable. You can plug into APIs, which essentially allows you to build that kind of stuff on top. Some countries there's not even an ID, right? So there's variation. So we use phone number, we use face matching, we use liveness detection, we use other things. And it may be good enough in the local context, but sometimes not for cross-border. So I think, South Africa is very different. I mean, Rwanda has an ID system that is fantastic. It's just as good as Singapore, Hong Kong, or Europe. But, I don't know. I mean, Mauritania is maybe not as sophisticated. So you have to kind of pick your market. But I think the mindset is, okay, people know they have to do eKYC now, and it's going to be more and more mainstream, I believe.
Yeah. So I think our experience of it comes primarily through one of our portfolio companies, Small ID, which powers a lot of facial recognition KYC for institutions, banks, as well as other startups. And certainly, like, it's a really different environment to where it was before. But I think, especially for banks, right, I think what you want to look for is what other technologies they're running, right? Because eKYC doesn't exist into itself, right? You need to really consider like how they're doing other identity checks, how their core banking system works, how they're able to easily integrate this. And so I think the ones that have been successful have really spent a bit of time to understand the tech stack of the banks and institutions that they're working with. So I think that to me is really important. But broadly, I think the desire to engage in eKYC is very high. I think, again, in a number of the jurisdictions that have been mentioned so far, like, it is pretty forward thinking, and the regulators do allow for it, especially for follow-on transactions, right? Or especially if you've been already validated, or if the origin source of the eKYC data comes from a physical source, and then you eKYC from that point on. So I think we've moved forward, certainly, but I don't think we are widespread adoption yet. But there's a pathway.
And by the way, we are a very happy customer of Smile Identity.
Thank you.
And anybody going to Africa who needs KYC, I mean, they can definitely help with part of it, and just fantastic company.
Well done, Mark. And it touched on another question, which is the level of adoption of digital processes from existing players. I think there's interest in what's the entrenched behavior, and then how's competition kind of disrupting that. And so we've touched to this, and that it's varied. Any final thoughts on kind of markets that are most attractive from a digital adoption of the entrenched infrastructure, whether it's regulators, banks, MFIs?
I think it really depends what you do, because you could say that banks in South Africa are quite sophisticated, but mobile money in Kenya is far more prevalent in South Africa, and far more used and has far more usage. So I think it really depends on what you do, but I would say there are probably like 5-6 key markets where the adoption is through the roof, and there's a certain propensity to try new things. Because of course in Africa everybody's an entrepreneur, but there are some markets where if you launch, people will try it. Doesn't matter what it is, and they will find a way to kind of play with it, screw with it, see if it's good, not good. So I would say big question mark is what you do and finding the right match. But yeah, you can find it.
Yeah, I maybe want to touch on the point that Cedric mentioned at the very start of this conversation, which is, the enemy is not the banks, right? The enemy really is cash, and the enemy really is not being served any financial services at all, right? So I think there's such a wide, slate to play on that you don't necessarily need to address the same products and the same segments that banks are addressing. I think if anything, banks are waking up to the fact that they need to address those long missing segments and long missing products, but I don't think many of them have a clear strategy and pathway as to how to do so, and so might be looking for advice and partnerships as well to make that happen. Obviously, banks have had entrenched interest for a long time, so make sure you have an experienced negotiator and sort of front person there when you do work with them. But I think many are pretty open to working in a partnership mode too.
I think that is the perfect hopeful note to close on. We are just at time, and this has been a lot of fun. There are a handful of questions that we haven't gotten to. I'm happy we got to a few of them with this panel, and the E&Y team will address those offline. But thank you for everyone's engagement. We know the emerging middle class across Africa is the key to unlocking prosperity on the continent and frankly globally. And so building a financial system that is centered around inclusion is critical. Huge shout out to the Mumbai FinTech Hub and Global Market Access Series, sponsored by E&Y. Thank you all for bringing us together, and thank everyone in this room and the participants, particularly our esteemed panelists, for dedicating a good segment of your life to changing the area of financial inclusion and helping spearhead digital transformation that we believe and we hope will transform the continent, build economies, and serve the historically underserved. So with that, thank you for all of your work. Thank you for your insights. Thank the crowd for the engagements, and thank you, E&Y.